Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Roman.
And I'm Michael.
Designing a retirement portfolio is one of the thorniest problems in investing. The mix of assets you choose dramatically affects how much you can safely spend during retirement.
Today, we're delighted to have the creator of Portfolio Charts join us to discuss optimal asset allocation. Tyler has modeled retirement scenarios around the world, identifying portfolios that help you sleep well at night and make the most of your money. All right, let's get into it. So thanks so much for joining us today, Tyler. As you know, Roman and I are massive fans of Portfolio Charts.
Oh, you guys are very kind. It's awesome to be here.
I think it's probably the tool we point people to more than any other than except maybe the Federal Reserve database, Fred. So you're doing pretty well to be number two to that.
Okay, yeah, I'll take that. That sounds fair.
So what we wanted to talk to you about was this new tool you've published in the last month, which is around global withdrawal rates, which sounds slightly unusual. So can you run us through the question you were trying to answer with this new tool?
Sure. So I think if there's one question, it's probably trying to figure out which portfolio has the best safe withdrawal rate in the worst case scenario, not just in the US, but around the world. The safe withdrawal rates are pretty popular topics these days, but if you look at the vast majority of research, they're overwhelmingly heavily US focused. Some of that is just from like data availability, where the US data is the easiest to come by. But I do think that introduces a lot of bias into the topic, where they say they want to focus on worst case scenarios for retirement, but they look exclusively at the best case country for that data. It seems kind of counterintuitive. So what I wanted to do was to try something a little different and to broaden the playing field in terms of data and look at withdrawal rates, not just in the US, but in 10 different countries around the world. And the other thing that specifically wanted to have some heavy focus on was also the portfolio assumptions, where if most people look at just stocks and just bonds, like large cap stocks and intermediate bonds as their only two options to invest in, that actually doesn't really describe the full options available to investors today. So I wanted to look at not only more assets, but also many more portfolio combinations. So I have 8,008 different portfolios I looked at. That's every combination of 7 assets with 10% intervals, just doing some fancy combinatorics tricks. But putting those two things together, that means that we have tons of portfolios in many different countries, and we can get a much better idea for more interesting portfolios and much more nuanced worst case scenarios to have a better feel for what really is the most consistent options around the world.
So you mentioned the safe withdrawal rate. Maybe up front, it's worth us defining what we actually mean by that.
It's a little bit of a loaded term because there's so many assumptions that go into that phrase that you do have to understand it. The man who made that popular was a guy named William Bingen, who wrote a paper, I think back in the early 90s, that talked about safe withdrawal rates for the first time. And the reason he did that is at the time, the standard advice for advisors to retirees was trying to figure out how much they could spend in retirement. Oh, well, here's about the average return of your portfolio over time. So you could spend about that much, and that's the safe amount you could spend. But he was noticing that like an uncomfortable number of people were going broke in retirement following that advice. So he was trying to take a more analytical approach to maybe find a better number. So what he did is he looked at the historical data from 1926 in the United States, and he calculated, ran some scenarios for people starting in every different year in 1926, 36, 46, and figuring out how much money could they have really spent every year adjusted for inflation, so in constant purchasing power. And how long would their money last? And he found that about 4% would last, even in the worst case scenarios in the US, about 30 years. And that's kind of where the 4% rule that is very ubiquitous today comes from. He called that the safe withdrawal rate, and that's kind of the term that stuck.
So in practical terms, we'd look at our portfolio on the day we retire, assuming we're going to live another 30 years, and we'd say, I can withdraw 4% of that each year, uprated for inflation.
The important caveat there is the safe withdrawal rates by default, they assume the 4% is from your initial portfolio value the day you retire. And then you adjust your spending allotment by inflation every year, but not by your portfolio return every year.
So just to be absolutely clear, let's say that, just to make the numbers easy, I mean, it would be a crazy amount to have, but let's say you've got 100,000 in retirement. and you start off with a 4% withdrawal rate. You take out 4,000 in your first year, and then after a year's passed, you'd increase that by inflation over the previous year. And do you rebalance your portfolio as well at that point?
Yes. So the calculations always assume, my calculations always assume that the portfolio is rebalanced back to your target percentages every year. That way you have a set allocation that is constant over time, and you're able to keep the same purchasing power as you go.
And so that was the study that really kicked off this whole withdrawal rate topic. And what did he say about asset allocation?
So he looked at a handful of different portfolios, mixes of U.S. stocks and bonds, and he found that the best portfolio with the withdrawal rates was about 50% stocks and 50% bonds, and that the 4% rule would last for about 30 years. One of the things I like about him is how honest he is about his research. People like to treat him like the 4% rule is like a law of nature, but he was very honest that there are other assets I didn't even consider because I didn't have data for that may work very well. So he even said things like gold. It deserves research to look at things like gold can affect withdrawal rates, or things like foreign stocks and bonds. He didn't look at those either. And so that was one of the inspirations for me for building my own tools, is like really respecting the work that Benga did, but hearing some of his areas that he felt like were areas for more research. And hey, I have enough information to be able to fill in the gap. So what can I do?
And so the asset classes that you looked at, as I understand it, were domestic stocks, foreign stocks, domestic bonds, foreign bonds, domestic bills, which is kind of like cash, commodities, and gold.
That's right. So I track a lot more, many more assets than that, but those were the 7 that were like the most universal, that someone in any country would have access to some combination of those things. And they also represent a really wide variety of things, well beyond what your typical financial back testers probably have access to.
I've got a question about the particular choice of fund that you're going to have for each of those slots, because let's just take one, right? Commodities. Now there, you've got lots of different choices, and there are things like roll cost, all kinds of things which you could take into consideration.
Right.
And the actual return you get will be vastly different depending on the particular thing you go for. So how did you create a kind of universal commodity exposure for your back testing data?
So yes, in terms of like the commodities fund, I do have a preference towards actionable information. So instead of using like some academic thing where I'm trying to put together a whole list of commodities returns myself, like from Palmer French data, I default to index like the S&P GSCI index, followed by some specific index funds like GSG. They're much more rare than some of the other things. And you're right, Raman, that there are many different definitions of commodities in general. That's probably the most loosely defined one on my list. But generally speaking, that's the index I follow. I'm trying to stick to things that a normal investor can buy with an ETF as opposed to having to kludge it together themselves.
But the other thing which you can do with portfolio charts, which is really cool, is you've got a little drop down in the top right corner of a lot of the pages where you can choose a currency. And that automatically switches to your domestic currency, which is really important for bonds, for example. But also the inflation rate it uses will be your local inflation rate. Is that right?
That's absolutely correct. So when you change the country on portfolio charts, it adjusts all the numbers for local inflation. So like the CPI data for every single year in your local country, not just some long-term average over time. And also the exchange rates for that year. So everything, like I collect my data in US dollars, but when you see it on the site, whether you change it to your country, it'll always represent it in your home currency. And by doing that, it helps every chart when you're looking at it, no matter where you live, to represent your actual own local purchasing power, not just the purchasing power from some dude across the planet.
Now that's a tall order, because before 2002, there wasn't a euro. So say, for example, you're looking at Italy. How did you get all the historic data on the lira? Did you find that difficult to obtain? Did you have to pay for it?
Didn't have to pay for it. So I've become a bit of an expert at finding free data over the years. And there are places that have free exchange rates looking back all that time. Sometimes you can get it directly, and I don't know the sites off the top of my head. Sometimes you can get it indirectly, like when you have index sites where you can download historical index data, and you can get US data, you can get Italian data. And when you have the returns for both, you can manually calculate what the exchange rate must be over time. So there are multiple ways to get back to the same numbers.
And we could just look at the returns for the British peso and weep into our spreadsheets.
Yeah.
So it sounds like for this withdrawal rate tool, the global withdrawal rate tool, you've got 7 asset classes. You've got 10 different countries, which you can model from the perspective of being a retiree in those countries. This sounds like you were crunching an enormous amount of data because you've gone back to, 1970 as well?
Yes. So I'm looking at every retirement start date since 1970 in 10 different countries, looking at 30-year retirements was the time frame I picked for this study just because I had to bound on something. And I tried to pick something that was similar to like the Bingen study and FAL studies and the most common definition of safe withdrawal rates that people use out there. So that's about 400 scenarios that I was looking at for every single portfolio. I guess one nice reference point, if you think of the Bingen research, it had data since 1926, my data since 1970. That's actually a common complaint about my withdrawal rate numbers is that because I only have data since 1970, I actually not covering many of the worst case scenarios that happened over time, whether it's the Great Depression or a lot of the worst case retirement timeframes actually started in the 1960s. So people are worried that because I have much less data, my withdrawal rates aren't reliable. But I like to think of it not so much in terms of timeframes because it's about more than that. Safe withdrawal rates are really about worst case scenarios, about scenarios. So Bingen's original study, by having 30-year retirement starting in 1926, at the time he wrote his paper, he had about 51 scenarios that he was studying to find the worst case. But in my study, even though I only had data since 1970, I have data from 10 different countries. So I have 400 scenarios. So in terms of like the breadth of thinking about all the different things that could happen and looking for worst cases, I actually have 8 times the amount of reference points than even some of the longest term studies that are out there.
Yeah, you've included Japan, so you're going to have some pretty nasty scenarios in there.
Oh, of course. Japan, Spain, there's a lot.
But you didn't have failed countries. Well, I say failed, countries that decided to scrap their entire stock market.
Correct. Well, let me put it this way, that scrapping an entire stock market, no. Well, and since 1970s, there aren't any examples in the countries I have for like a country completely failing.
Oh, we'll get there soon. Don't worry, Tyler.
Oh, yeah. Man, yeah, things are rough, aren't they? But the reason I picked the 10 countries I did is they're the 10 largest developed countries as defined by most like index fund providers. So, Australia, Canada, France, Germany, Italy, Japan, the Netherlands, Spain, UK, and the United States. And I believe that's important to have like economic contemporaries when looking at the data. So you're not mixing data from something like the giant gorilla United States data and then mixing it with Latvia, which nothing against Latvia, but its entire market capitalization is probably equivalent to a single mid-cap company in the US.
And in terms of what we are actually trying to maximize here, as I understand it, there's 2 things. So there's the safe withdrawal rate, like we've discussed. Ideally, you want that as high as possible so you can spend more every year of your retirement. But also the other thing you've looked at is called the ulcer index. Do you want to explain that?
So the ulcer index, when people talk about like efficient investing or the trying to find the best bang for your buck, the most common stats that people look at are your average return and the standard deviation. The ulcer index is an alternative metric I like as something different from the standard deviation that I feel like is a bit more useful or understandable to a normal person. So the ulcer index was a number invented by a guy named Peter Martin. And what it does is instead of just looking at a standard deviation looks at the variability from the average of the return over time, the ulcer index looks at every loss and combines both the depth of the loss and the length of the loss to get like a single number that tells you a little bit about how painful a portfolio is. The reason that's important is that, there are different types of pain when you're investing. Everyone knows like when you lose 50% of your money, that's really painful. But if it comes back very quickly, you can get over that pain relatively, easily enough. The other type of pain is when things don't necessarily drop that quickly, but they just decay and stay low for over time. Like if you're invested in some cash fund, that all it does is kind of decay to inflation for what feels like forever. That could be just as painful or even more so than something that, drops sharply and recovers quickly. So an ulcer index is basically a summary number that accounts for the depth, the length, and the frequency of portfolio losses. And the bigger the number, the worse your experience.
So it sounds like we've got two components we're looking at, kind of like risk and reward, the risk being ulcers and the reward being a higher safe withdrawal rate. And we're presumably trying to balance those two things against each other.
Yeah.
So you crunched all the numbers, all the data. What did you find? What were your key takeaways?
Well, I'm sure that most people want to know, what's the best portfolio? What should I invest in? That's,
yeah.
We could talk about that, but that's honestly not really wasn't my purpose for doing this, is to find the one thing to pitch to everyone. I'm a big believer that, well, if there's one thing I've learned writing about and researching portfolios for a long time now, is that there's no one magic portfolio that's appropriate for all people. Even if it could work well, either their own personal financial situation or their emotions or just their preferences or what makes them sleep at night, everyone's different.
Are you sure you don't want to just package it up as an ETF, sell it and make millions?
I'm not saying I'll never do that. But no, I prefer my style is to present information to educate people so that they can make educated choices and feel good about what they're doing. But to answer your question, and not just totally wimp out, I think the biggest takeaways that I found was that it's really all about diversification. So the secret to maximizing your safe withdrawal rates is really thinking beyond your own country, thinking about what diversification means, and thinking about worst case scenarios so you can build a portfolio that's not just optimized, but consistent. And so that means thinking about assets that play off each other. Some things will do really well in some situations. Some things will do really poorly, and that's okay. That doesn't mean you buy all of them and only focus on the things that do well. One of the things I kind of compare this to is like if you're baking a cake, and if you only include ingredients in the cake that taste good on their own, you'll add a bunch of sugar and maybe some chocolate, and that may sound great, but once you put it together, it's going to be garbage. But things like salt, things like baking powder, things like oil, things like eggs, if you take a spoonful of that, you'll gag. But those are all important things that have a role to play in a portfolio, and that applies to not just in accumulation, but in retirement as well. So when looking at some of the data internationally, the things that jump out to me is thinking about the importance of stuff like foreign bonds. So thinking outside of your own bond market, a lot of people get too caught up on just bonds as being a local thing, but there really are some good global options out there. And thinking about things like commodities and gold, I think one of the things that people miss about those two assets, some people hate them because they're just unproductive things that sit on the side, and they have a natural inclination to prefer productive assets. That's the mantra in their head. But another way to think about something like gold is it's the true most global asset on my entire list. Beyond just being like a foreign stock that you'll buy a foreign stock fund that maybe has stocks from 23 different countries around the world. Gold is the truly global traded asset that's traded in every single country around the world.
Well, let's put a pin in gold for now and come back to it because it is controversial, like you say. But let's answer the question you said isn't the question. So what is the portfolio when you look at all 10 countries over this 40 plus year period? What is the portfolio with the highest global safe withdrawal rate?
All right, I'm looking it up right now so we could just talk about it directly. All right, here we go. So yeah, the number one global safe withdrawal rate portfolio has 10% domestic stocks, 30% foreign stocks, 20% domestic bonds, 10% commodities, and a pretty sizable 30% allocation to gold. There's a couple ways to break that up, but it's about 40% stocks with a modest home country bias, which is a reasonable thing for a lot of people no matter where you live. About 20% bonds, and another 40% commodities or real assets in Med Faber's terms. So it's real assets, so things that are tangible that are outside of just your typical stocks and bonds. So you cover the three major broad asset classes and kind of 40-40-20.
Would I be oversimplifying it by saying the stocks basically drive you towards return over the long term? The bonds are kind of a hedge against deflation, and the real assets are a hedge against inflation.
I would argue that's an oversimplification. If you're looking for an economic justification for each individual asset, I think that what you just said makes a lot of sense. But modern portfolio theory is about more than just what each asset in isolation does. What really makes some of these portfolios tick is how they work together. I do believe in the idea of having assets picked for specific economic conditions. Like you said, that commodities may be better for inflation, stocks may be better for growth, bonds may be better depending on the type of bonds for deflation or inflation. It kind of depends, the cash versus long term. But it's also about the intermix and why things like 40% stocks and 40% real assets. The reason that ticks isn't just that one is good for inflation, one is good for growth, is that they complement each other. And with things like rebalancing bonus, of when you actually rebalance in between these things every year, and that's the natural mechanism of selling high and buying low that you're doing automatically without having trying to predict the markets, that actually does add measurable risk-adjusted returns to your portfolio over time, which has a very particular benefit to safe withdrawal rates. So some of it, yes, is economic justification of each individual asset, but they aren't necessarily picked just for that. It's also how they complement each other in a portfolio.
Can I just ask a quick question about the bonds in that kind of mix? I've noticed that, well, obviously, if you're in the UK and you're on Vanguard, which is like the kind of vanilla platform now, almost all of the bond funds, global ones, will be currency hedged. Now, I assume that your stuff doesn't assume there's any currency hedge there at all.
That's correct. All of my data is unhedged.
So would that have made a difference to the result? Because I guess if you've got something safe, you don't want to overlay something which isn't safe, which is the currency exchange rate. I can think of that in two ways. I mean, if there is a big crash in your economy, it devalues your domestic currency, so that could flatter the foreign stuff.
Mm-hmm.
And yet at the same time, one of the points you make in your article is about you don't want to buy the bonds of a economically shipwrecked country.
Right.
So, there are two arguments that I could make, I think, about whether you should do that or not. I mean, what's your take on it?
Well, I'll say right out that I don't have data for hedged bonds that I've run through this, so I don't know the direct analytical answer to say directly. My intuition from studying this for a long time is that hedged bonds would make a difference, but I'm actually not sure which way it would be. The reason that hedged bonds are useful in a portfolio, and maybe you would correct me, but from my perspective, they're really helpful if you're depending on bonds for the coupon payment. If you want the regular income every year, and that's what the purpose your bond portfolio is serving, then that's when hedging comes most handy. Where it's less helpful, where unhedged bonds can actually more be beneficial, is a more modern portfolio theory style portfolio where the volatility of the bonds are just as important as the volatility of stocks to balance the assets as they go. And so in terms of withdrawal rates, I can't say for sure which portfolios would benefit most for the hedge bonds. I don't believe all of them would. And I'd have to do a lot more research to kind of understand that better.
And for the portfolio you just mentioned, which came out top in the list of the highest global safe withdrawal rate, my understanding is that would give a safe withdrawal rate of 4.44%, an ulcer index of 8.75. Maybe you'll have to contextualize these numbers for us. And the worst case scenario, where it would have just run out after those 30 years, was if you retired in Japan in 1990.
Right. That's all true. So yeah, an ulcer index, for a reference, you see it's about 8 or 9. The ulcer index, I guess, as a reference point of just 100% domestic stocks, if you look on a global perspective, that would be over 40. The pain of holding this particular portfolio is drastically lower than holding your typical 100% stock portfolio that a lot of people are kind of naturally biased toward as the simplest solution for this type of thing. So yeah, it's absolutely, quite low on the pain risk, which is one of the things that makes it so appealing.
Because it sounds too good to be true, doesn't it? Like we've got a withdrawal rate higher than the 4% rule and the ride is much less painful.
Yeah. So I don't believe in magical things. That's why I don't, like I mentioned before, there's not one portfolio to rule them all. But on the other hand, that's the magic of modern portfolio theory and smart portfolio design, is that by thinking beyond your typical constraints that hold a spec, that 4% rule that people were anchored on, it's all based on 2 assets in the US. But once you look at 7 assets around the world, and there's an entire new playing field of options.
I think your point about not focusing or kind of locking in on one portfolio is a really good one, because just as an anecdote, I had a client once that actually presented to me an entire slide deck based on portfolio charts where he'd gone through and he'd worked out for his particular circumstances which was the best portfolios. And he actually presented a whole slew of these. He didn't do just one. And that's the really important point, isn't it? That's why you present a cloud of portfolios, as it were, because it might just be that because Spain had a particular problem in 1970, that the whole portfolio hinges on that one data point. So that's the worst case. But in fact, if you slightly modify it, you can come up with similar portfolios which come up with a similar outcome.
Absolutely.
Or even quite different portfolios that come up with a similar outcome.
Well, to start, I just want to say I really like your client. He sounds like a smart guy. But yes, you make a very good point. And so the sensitivity to each individual country is an important thing that it didn't want to just gloss over by presenting a bunch of summary data and ignoring the details behind the scenes. So that's why I thought it was important for me to not just share, like, here's the top portfolio, but I created a tool that people can go online and they could tweak the assumptions themselves. They can remove specific countries, they can remove specific assets. And so they can really dig in to find, just like you said, maybe there is one portfolio, the one that comes out on top. It sounds great, but if it could be driven so much by, like you mentioned, the worst case for this best portfolio on the side was in Japan in 1990. We'll exclude Japan, and that might be something much better and you're just as comfortable with. So having that transparency into some of the core data and the ease to be able to kind of explore it yourself is really part of the education that I think makes this the most interesting to me. I don't like to listen to people just to hear them tell me what I should do. I like to learn how things work so that I can explore it for myself and really grok it and put your arms around it and find. So that's how you become comfortable with what you're doing beyond just trust. It's an inherent understanding of why you're doing what you're doing. And that's one of the things I like to contribute to.
Can I just point out to Michael that the word grok is from Heinlein? That's science fiction, Michael.
Yeah, I have to tolerate Roman's science fiction obsession. One thing that struck me when I played with the tool was that if you go country by country and just look at the safe withdrawal rates, it varies quite a lot. And actually the portfolios can vary quite a lot, can't they?
Yeah.
The UK looks like a pretty good one, actually. Our safe withdrawal rates, I think, above 5% based on a specific portfolio.
Yeah, the UK is kind of right up there with the US in terms of some of the better safe withdrawal rates if you're looking at individual countries. I don't have any grand economic justification for why that is, but historically speaking, the UK has been, very lucky in that regard. But I also think that it's important not to fixate, just like I say, it's important not for US investors not to fixate on US data. I think it's important for UK investors not to totally fixate on UK data too. If I were to open a tool like this, I would look at my own home country first too. I mean, that's just the natural human nature. But kind of the point is to think beyond your own lived experience and to kind of be able to put yourself in the shoes of investors in very different countries around the world. And that getting that breadth of possibilities really helps you understand, not just the worst case scenarios and in some place you feel like you may never experience, but it helps you understand just the breadth of possibilities so that you can plan more conservatively no matter where you live.
I think that's right, because what if we were the next Japan? What if we were the next Italy? You never know, right?
Yeah, absolutely. And yeah, things like Brexit are changing the economy in ways that we're still figuring out.
Now in PensionCraft, we also have modelling tools to help you decide how much to save in retirement, but also how long your pot is likely to last and how much to withdraw each year. To get access to that and all the other goodies that come with membership, simply go to our website, PensionCraft.com.
Can I ask about the domestic overweight in the stock allocations? Because that seems to come out again and again with whatever portfolio you tend to model, is that it looks like it's a good thing to have a domestic overweight, which is something that surprised me, particularly as a UK investor. And is that because of something to do with the relationship with domestic inflation or something else?
So every time I've looked at this over the years, even well before I did this research, I've looked at withdrawal rates for different countries for a long time now. I've seen the same thing, and that the domestic overweight is something that always rises to the top. My theory that I think is borne out by the data is that it comes down to withdrawal rates are all about maintaining purchasing power. And the two things that most strongly affect purchasing power are your local inflation and the exchange rates if you're investing internationally. So the reason that the domestic overweight, the allocation, always seems to help countries in terms of withdrawal rates is that it's those domestic assets are the things that are actually tracking their local inflation and divorcing them from the damaging exchange rates that may affect the things over time. So even if you look at something like Japan that have went through some horrible stock times, even if you look at Japan, a domestic overweight towards Japan stocks over just a global market still helps their withdrawal rates. And that just tells you how important tracking your local inflation is. If you think of your assets as the engine that drives your retirement portfolio, if you're latching your hopes to the engine of a country halfway across the planet, it actually may not be following things properly in your home country to maintain the purchasing power you need.
Roman, are you going to be drafting an apology letter to Vanguard?
No. Because one of the reasons I always say, in the UK, we've got life strategy funds from Vanguard. And one of the reasons I don't like them is because of the UK overweight. Because pretty much since, 1900, the UK's underperformed the US. So just by having a UK bias, it would have been a drag on return on average over that period. So if you're in a country that's been in long-term decline, which is pretty much where the UK's been for a century or more, certainly as a percentage of a global market cap, I should qualify that, then it's underperformed as a result. So, maybe that's going to turn around now, but it's just difficult to see that happening or what the catalyst would be.
So if you're talking about accumulation in general, like the total life cycle, I would probably tend to agree with you. But if you're looking specifically at withdrawal rates, the inflation is so important to what you're doing because it's all about paying the bills when you take out your money at the end of the year. And it's a very fixed thing that your rent isn't going to go up and down with your portfolio every year. Your rent is fixed. And so it's important for your portfolio to be able to track that local inflation reasonably enough to keep your spending power and your withdrawal low enough to maximize that withdrawal rate. And also, since we're talking about overweight, just to be specific, we're not talking about 100% local stocks. We're not even talking about 50%. We're talking about, maybe 25% is what comes out in the top portfolio from my research. So within your stock allocation, about 20 to 25% of it, that seems to be your tilt, which is heavy if you look compared to the global market weights for any country outside of the US. But in terms of the whole stock allocation, it's not completely overboard.
So, for example, if you were in Peru, do you think you'd still go for a quarter of your equity being domestic? I mean, does it depend on the country you're in, do you think? Or would you just kind of take the global average?
That's a fair question. So to be honest, I restricted this study to 10 largest developed countries for a reason, because I felt like they were economic contemporaries and we can make reasonable conclusions that kind of mixing that data together. If you're looking at a very small country like Peru, I might have a different opinion. I don't have the data to back it up, but my inclination would be, in that case, you're probably best suited being as globally diversified as you can. I still think my point about global or about local inflation still stands, but everyone has to be realistic about their local situation. I can't speak for every local person around the entire world.
One of the things we noticed, I used to be in a macro research team, and one of the things we noticed was the correlation of inflation across the world seems to have increased over recent decades. And for example, if you look at the big inflation spike we just had, and that was driven largely by energy, they often are, it was seen and felt all across the world. So, maybe a global portfolio is a better hedge for that now because you're going to get the inflation hedge from the equities.
Yeah. So you may be speaking in terms of truly global, even with small emerging market countries, but was one of the original purposes of the European Union, was to be able to standardize or help harmonize the inflation across Europe. So that would be a reason that inflation has become more hegemonous in recent times, is because it's by design. So yes, if you're looking today compared to some of the historical data, I think it's fair to say that the inflation for a European investing within Europe may be a lot more under control now than it would have been just looking at some of this historical data where every single country was acting independently.
On the PensionCraft forums, I often notice that people haven't really decided where they're going to retire. Living in Europe gives you the option to move across different countries. So maybe that's another complication when it comes to a domestic overweight. What counts as domestic?
That's fair. And that's one of the things I've always enjoyed about Europe, is the ability to move like that. I think that The advent of the modern European and Euro area funds is something that helps make that work. You can invest in some of the local European market as a whole, as opposed to individual countries. You don't feel like you have to necessarily control things for every country you're in.
All right, let's stop giving you a hard time about domestic overweight. Let's give you a hard time about gold instead.
All right, let's go for it.
So, as we said, in that sort of best portfolio in inverted commas, that's got a 30% allocation to gold.
Mm-hmm.
Now, that seems high, doesn't it, when you look at it in comparison to sort of typical allocations?
Sure, because most people don't even consider gold at all in their allocations. But yes, it is high. Compared to common advice that considers no gold at all, it's high. Even compared to other portfolios that I track, like the highest percentage on the site is with the permanent portfolio, which is 25%.
Yeah, that's what I was getting into, is that it sort of blows everything out of the water when it comes to gold. And, you've got the stats there. It's not like you're plucking it out of the air. You're saying, genuinely, right, gold is adding a lot to a portfolio. I'm just curious to what your take is on why that would be the case.
Well, okay. So as a good way to start that, let's skip to the worst possible portfolio, the absolute single worst portfolio that I studied that I found. So if you look at 8,008 different portfolio combinations of 7 different assets across 10 different countries, the one portfolio that had the absolute worst withdrawal rates was 100% gold. That's the reason why people have a problem with gold, is that when you look at gold by itself, no matter whether it's accumulation or retirement or whatever it is, it's a really rough thing to invest in. It has very high highs. It has extremely low lows. It peaked in the 1980s and was like underwater for the next 20, 25 years in real terms. So if you're the type of investor that only looks at assets in isolation to decide what to invest in, gold is a horrible choice, and it will always come out on the absolute bottom. But
are you going to tell me it's baking soda?
Yeah, yes. It's the salt. Or think about it like if you want to stick to metals, it's iron. So you need iron in your diet in order to live. But you're not going to go eat an entire, plug of it. You're going to die. So just like in chemistry, the dosage matters when it comes to gold. But if it's all you ingest, you're not going to do well. You're gonna go broke. But in the right percentages, it could be something that absolutely measurably can improve your portfolio outcomes. Now, whether 30% is the right amount for all people, that's certainly up for debate. I have no problem with people dialing that back to something that they're comfortable with. There's nothing wrong with that. But in terms of finding one particular asset that is probably the best complement to stocks that people don't pay enough attention to, I would say it's gold. And that's for 2 reasons. One is it tends to take off in times when stocks do the most poorly, not just like in the 1970s, but also like in the whole decade of the 2000s where stocks were underwater for 12 years. Gold did great. And the other reason is that, like I mentioned earlier, gold is a truly globally diversified asset. So if you're the type of person who believes strongly that global diversification is important, gold is actually a very good asset for that. So by those 2 things together is one of the 2 things that I think make gold so useful in portfolios.
Now, do you think the time period that you chose kind of flattered gold? Because obviously the really awful period, which is what your methodology focuses on, which would probably be in the 1970s when we had super high inflation across much of the world. In the UK, for example, inflation peaked above 20% and it came in a double peak. It was just absolutely terrible.
Yep.
But of course, we just come off the gold standard in many of the countries around the world. And some people claim that the destabilization that we got in currencies and in inflation was due to the fact we'd come off the gold standard and gold was finding its level. You take the cork off a bottle and it's going to erupt. And similarly, gold perhaps was set too low relative to the dollar. So do you think that some of the benefits of gold were due to that period in the 70s?
Yes and no. If you're looking at individual investing timeframes starting in the early 1970s, then yes, gold absolutely skews the returns with it. Between like 1971, when Nixon ended the convertibility of gold to the dollar, through 1974 or 5, gold quadrupled in value as that was the end of Bretton Woods. The gold price had been fixed globally for like over 100 years. The gold return was effectively a legally set 0% for many decades. That uncoupling of the price of gold from that legal framework is what allowed it to finally take off and what allowed it to be the volatile asset we see today that is so wild. It makes it such a rough ride. But so yes, those first couple of years, gold quadrupled. If you're only studying things started in 1971 through that would unfairly bias the results. But the good thing about this type of research, not just withdrawal rates, but in also other types of things I do that looks at every start date independently and simultaneously, is that it also accounts for the very worst case scenarios. So I'm not looking for the best case scenario. So the early 70s is something that gold isn't skewing. The worst case for gold was like in 1981, starting then when it cratered in value. But okay, going back to your point, there are two ways to think about it. There's one camp of people who think that portfolios, including gold in the early 70s, to your point, were lucky because that was the very bad time for stocks. Gold happened to do extremely well at that time. And so it kind of bailed out the worst case situations in a way that's unrepeatable because of the way the coming off the gold standard is a one-time thing. So I totally understand that perspective. The second perspective is what you mentioned, is that the cause of the high inflation and the soaring interest rates that destroyed bonds was the end of the gold standard. So the gold and that negative situation are actually directly correlated. And so if that's the case, then studying gold is actually a really important thing. You get to see how it ties in with the different economic cycles and the other types of assets. So personally, I'd wend towards the latter, that I believe economically speaking, I think that the end of Bretton Woods and the allowing gold to finally free float was a thing that caused a lot of those things. So I'm interested in that time frame. But I'm also not a gold bug. And that's one of the reasons why, like my tools, I specifically allow people to take gold out to see what happens without it. And why I have no problem with people who like to invest in different types of portfolios they're more comfortable in.
I mean, that's the point. You can still get a really good safe withdrawal rate by taking gold out. I think the best portfolio in terms of the highest safe withdrawal rate without gold is 50% in stocks, 20% in bills, 20% in foreign bonds, and 10% in commodities. Mm-hmm. It seems like foreign bonds are sort of stepping into the mix a bit more.
I'd say it was domestic bills. It's cash. I'd say that that's the kind of safe ballast, which has also stepped into the breach for gold.
It's both. But I will say that one of the things I personally noticed was the importance of the foreign bonds. If you look at the best portfolios for the individual countries, including gold, they all have a sizable allocation of gold. And interestingly, none of them have foreign bonds. But once you take gold out of the mix, virtually all of them have some allocation to foreign bonds. So that, to me, that tells an interesting thing, not just about foreign bonds, but about gold. And it kind of reinforces my perspective that gold is a powerful international asset. And when you take that off the table, then your portfolio, your safe withdrawal rates seek the next best international asset and not just foreign stocks, but that tends to lean itself towards foreign bonds as well.
I think what we talked about earlier in terms of currency hedging bonds, I think this probably relies on them not being currency hedged.
You're probably right, yeah.
You can think of it like a hedge against having Muppets as politicians. If they really screw your economy, then some of these assets come in to save the day.
Yeah, absolutely. That's the beauty of diversification in general. People understand it in terms of you invest in more than one company because in case that company goes poorly, you have many more to back you up, but the same goes with countries as well.
Could you talk about cash just briefly? Because I say cash, what I'm talking about here is domestic bills. And when you take out gold, they also appear in the portfolio, 20% in bills. Now, bills, you could also substitute a money market fund. For example, it would give you very similar returns and risk. So could you just briefly talk about that and why you think it's important?
One of the most interesting things to me when I was looking at this data is in the process of doing this, I took all these different portfolio options and I specifically looked at what is 100% of each of the 7 individual assets. How did that do well? The absolute worst case, like we talked about, was gold, 100% gold. 100% commodities was also quite poor. Well, 100% stocks was actually right down there too, and that kind of tells you just how risky that is. But the thing that surprised me the most is that the single best asset, if you were to pick one to put all your money in terms of safe withdrawal rates, is 100% bills. And that's like so counterintuitive to what we're taught today. And I think that goes down to how people are trained when they learn about money and they learn about investing. People are trained around the idea of averages. But things like safe withdrawal rates don't look at averages at all. They look at worst case scenarios. So the thing that those averages hide is all these worst case scenarios. You may look at like the average for stocks. I'm just going to make up numbers. Let's say it's 7% real, the average return for a stock fund over time versus 1% real for a cash fund. It may seem like it's a no-brainer that obviously you're making 7% a year. It must be better for retirement than the 1% a year. But the thing that average hides is the worst case. So the worst case for cash might be like negative 10%. We know when you're counting for inflation and it's just get a really rough inflation for a while. Worst case for stocks is like negative 50, 60%. And it's those worst case scenarios that define these withdrawal rates. That's why when you're looking at withdrawal rates, you have to think beyond averages and you have to think about consistency and dependability and the types of assets that lend themselves, and the type of portfolios that work together to have greater consistency are much more powerful in retirement than high average returns.
So that leads us on nicely, because you said that 100% stocks is, one of the worst portfolios maybe to hold throughout retirement, because it lowers your safe withdrawal rate dramatically. If you retire into a period where stocks immediately have a massive crash, you're going to run out of money. That sort of flies in the face of a paper which has become increasingly famous. It was published last year, called Beyond the Status Quo, A Critical Assessment of Lifestyle Investment Advice. And one of the upshots of that paper was where they say holding 100% equities throughout your life and throughout your retirement is probably the optimal strategy. What did you think? Why does your research differ so much from theirs?
Well, I'm glad you brought that up, because I guess if I'm being honest, I've been looking at withdrawal rates for many years. The reason I made this study now was probably inspired by this paper. So one of the questions I wanted to answer was what portfolio is the best in terms of, you look at all these countries, but the secondary question I kind of want to answer is it really 100% stocks? Because I read the same thing you did, and I had a lot of questions about the methodology and about the assets they used. And please, I'm going to say up front, I very much respect Scott Cederberg. And the whole team that went behind it. They're tremendous people. And so this is not a rap battle.
It should be. Come on.
No.
It's Drake versus Kendrick
yeah,
Lamar.
Kendrick. Yeah, exactly. No, I'll leave that to the pros. But so one of the things I did in the process of this research is I wanted to be able to do my best to study the exact same question they did of what portfolio is the best, but to have more fine-tuned control over things like the countries and things like the assets considered, so that I can understand why they were coming to the conclusion that 100% stocks was the best. Because that's the one thing I felt like was maybe underserved in their discussion is, okay, here's the result you had, but why was that the answer? Tell me more about the worst case scenarios. What countries were coming up in those worst case scenarios? I want to have more context. So the interesting thing for me is that one of the first things I did is I took my settings, I pared it down to the exact same assumptions that were used in the Cederberg study. What they did, at least in the section of the paper where they found that not just that 100% stocks was correct, but that it specifically found that 35% domestic and 65% foreign was the ideal percentage. But they were looking at combinations of domestic stocks, foreign stocks, and domestic bonds. Those were the three asset options and various percentages. So I used every country that I had. They had many more than me, but I used my 10. And I used those three assets. And the interesting thing to me is that I found is I was able to basically replicate the results. So even using less years of data, but with the a similar amount of countries, is that they found that 35% domestic was right. I also found that 100% stocks overall was the best allocation, but mine was about 20% domestic, but that's close enough, I would say, that was in the margin of error. But the important thing is I also am able to add more assets to consideration. So if you just add foreign bonds to consideration, which was interestingly excluded from the Cederberg study entirely, then the 100% finding no longer holds. It goes down to 60% stocks. If you take away the foreign stocks and just leave the domestic stocks and domestic bonds, the ideal portfolio is still not 100% stocks. It's about 60%, I believe. So really, while I can replicate their findings, The only way you can really do that is to look at the very worst case scenarios in countries like Spain in the 70s, coming out of Francisco Franco, where their currency was having all kinds of problems. And you're restricting your asset options to where you have two domestic things, domestic stocks, domestic bonds, and your only foreign outlet relief valve is foreign stocks. So if you think about in that case, think of it like a pressure cooker, where you really raise the pressure on your portfolio to the worst case scenario you can come out. And the only hole you allow for the steam to escape happens to be foreign stocks. It really shouldn't be a surprise that 100% stocks rises to the top as the best case scenario. But if you open the option field to other assets like foreign bonds or other commodities or cash, then you get very different answers.
So essentially you're saying their study was too narrow in scope to capture the same findings around diversification that you found?
Basically, yeah. And again, no slight against their research. They were looking for some very specific things about life cycle funds, that those life cycle funds tend to only look at domestic bonds and domestic and foreign stocks.
This is why you need to launch your ETF, man.
Sure. If you can give me some advice on how to set that up, we can talk.
I think there are companies that white label it in the United States, so they do everything for you.
There are, yeah.
You just tell them what goes into it and they just do it.
All right, let's get this done. But yes, that's why I think it's important to really expand your ideas and look at different types of assets, because the thing I learned, so I'm an engineer by training, and one of the things that's been drilled into my mind from a young age is the idea of questioning assumptions. So whenever I see a new study for anything, my very first thing I do is I look at all the assumptions that went into the conclusions that they drew. So that's one of the things that, whether it's a Cedarburg study or whether it's any other study, which assets did you actually even look at? Which countries did you look at? Why did you choose those? And what happens to the numbers if you try something different?
Do you think there's going to be some young upstart in 10, 20 years' time who comes along and says, Tyler didn't even add in Bitcoin or Beanie Babies. His portfolio allocation's way off. That's probably one of my most common emails is, hey, do you have Bitcoin data? I'd love to add Bitcoin data. We need more crypto. The answer is there's not enough history to be able for me to put that in my tools. I don't mind questions like that. And I don't mind people even criticizing my thing, looking at my own assumptions, because I do that to other people. So just to wrap it up, we've obviously talked so much about safe withdrawal rates, with the idea being that if you look back through history, you'd have been okay. Even in the worst case scenario, you wouldn't have run out of money over a 30-year period. But as we know, there's that small print in every piece of investing literature which says the future might not resemble the past. So in what kind of scenarios would even this cautious safe withdrawal rate fail, do you think?
Well, the thing about worst case scenarios is, and the thing about back testing is as you get more information, as time progresses, there's always opportunities for new worst case scenarios. One of the things that's actually a little bit unique about the way I even calculate withdrawal rates is that even though I'm looking at 30-year timeframes, I have a system that allows me to use historical average returns for portfolios to kind of predict how withdrawal rates are naturally decay over time once they get at least 15 years of data. One of the benefits of that is, as part of the study, it includes data even as recently as retirees starting in 2009. And if you think about the time frames like starting in 2000, right before the attacks on the Twin Towers, and in 2008, 2009, when there was a massive deep recession, those are some of the worst case scenarios for people that actually define a lot of the worst cases in many of the portfolios I look at that aren't considered by other retirement studies. That's just to say that there will always be some situation that comes up that may set the new worst case scenario. So you shouldn't treat, things with withdrawal rates like some law of nature that will never change. It reminds me of a story I heard once, like an allegory of someone in Peru looking to hire a driver to drive along a trail along the edge of a cliff, a very narrow road, with a steep cliff, like hundreds of feet off to the side. And they would ask each driver that they were interviewing, how close to the edge do you feel safe driving before you feel like you're uncomfortable? And, one driver would say, I could go within 1 foot. And then the next driver would say, I can go probably 6 inches. I'll be fine. And the guy they hire was the guy who says, I always drive as far away from the edge as I possibly can. Yeah. So there's something to say with that withdrawal rates too, is the purpose of withdrawal rates isn't to sit there and find the exact number that this is I'm going to take out every dollar that it says I can have. I still believe you should structure your life, structure your finances to spend the minimum amount possible in order to still be happy. And use the safe withdrawal rate more like the guardrail on the side of the highway that you don't want to touch, but it's there to protect you just in case.
And I guess in the truly disastrous scenarios, no portfolio is going to save you from global war or global communism, right? You can't be an investor through those scenarios and expect to be drawing 5% from your portfolio.
So one of the things I did in the process of like validating my own data is I compared it not just against Cederberg, not just against Bingen, but there's a guy named Wade Fowle that's done a bunch of really tremendous research in terms of international withdrawal rates, looking at data for a bunch of different countries. And so the cool thing about, he looked at not like at foreign diversification, but he looked at the withdrawal rates from the perspective of investors in a bunch of different domestic countries, looking at domestic stocks and bonds in UK and France and Japan. And so I was able to compare my numbers for each of these individual countries against his numbers just to make sure my calculations are, in the right ballpark. And what was reassuring is that for the vast majority of them, my numbers, even though he has data for, I think, since 1927 and mine starts in 1970, our numbers on average are only about 0.2% off. So mine tend to overstate on average the withdrawal rate by about 0.2%, which is actually quite good if you're thinking about the error even in data sources. The situations where that didn't hold up was in countries like Germany or Japan, all the countries that lost major world wars, or even places like the Netherlands that were occupied by a foreign force in a world war. And all it goes to say is that if you're looking for a portfolio that's going to give you a nice, comfortable retirement, even if someone drops a nuclear weapon on your hometown, you're going to be in for a hard time. There are some things in life that are just bigger than being able to live off a nice, comfortable portfolio, and you have bigger things to worry about. But if you're looking for like normal times, even some very bad scenarios, economic scenarios, that's where withdrawal rate data like the stuff I have, I think is helpful to put things in context so that you can have a better feel for the breadth of possibilities outside of, major disaster.
I guess those are the macro events which might wreck everything. But there's also the sort of personal element to consider. Like you might have a retirement period that lasts a lot longer than 30 years. That would obviously impact the data. You might not behave perfectly. You might not rebalance. You might not trust your portfolio and not hang on when stocks have a big crash. You've got to know yourself, right?
Yep. And to your point about the length of retirement, one thing I would recommend is if you've read the study about 30-year safe withdrawal rates, and you'd like to know more about longer term retirement periods, especially if you're in the FIRE group and you're interested in early retirement, is go back to my website and look at the withdrawal rates tool. What it has is information not just about 30 years, but it allows you to calculate the exact same withdrawal rates for a portfolio up to like 45 years. And I even have a metric called the long-term withdrawal rate that will show you safe withdrawal rates tend to decay kind of exponentially approaching a limit over time. And the long-term withdrawal rate is the safe like runway level that the plane landing on the runway eventually touches down to. That tends to be a little bit lower than the safe withdrawal rate, but it's also higher than the perpetual withdrawal rate, which is another term. And that's the type of thing, if you're looking for an early retirement, you can plan for that, and you have a very good chance of your money lasting forever. That's the way that endowments think about spending down money, is they find that safe perpetual level or that long-term level where it's self-sustaining over time, it doesn't deplete to zero.
Yeah, I guess one thing I'd love to see would be maybe a different type of tool, because some of the people I speak to, all they're worried about is maximizing the size of the pot for their kids. So if there's volatility between now and the end of the period, they don't really care because they've got enough saved away in property portfolios or whatever. And this is just their inheritance pot. Effectively, they're running an endowment for their kids. So do you think there's an approach which would help them?
For running an endowment, that's where I would really look at things like perpetual withdrawal rates or long-term withdrawal rates over safe withdrawal rates, because those are also the things that are meant to last forever.
So if people watch my content all the time, they know I'm a big fan of portfolio charts. So if you do want to check it out, just go to portfoliocharts.com. And I think you offer a membership now as well, don't you?
I do, yeah.
For a long time, you just asked for coffee, like it was just like a gratuity. But now you actually offer a membership as well, don't you?
Portfolio Charts is a passion project. I do it because I love it, not because I depend on it for income. But, things do cost money. So over the years, I've had the option for people to just donate. I do have memberships now. The vast majority of the information on the site is still 100% free because I believe it's important for people to learn about these things. But if you find it useful and you want to help give back and help pay it forward to other investors so they can learn too, the membership is a great way to help.
Thanks so much for coming on. It was a fascinating conversation.
Thank you.
Yeah, we both loved your article.
Well, thank you for having me. It's an honor to be here. And it's great to talk about these things. People might be surprised to hear that I get much less direct feedback sometimes than you might think. So to be able to share this is a great opportunity, and I really appreciate it.
Thanks. I'm sure we'll speak again soon.
Yeah, absolutely.
Thank you for joining us for Many Happy Returns. Do send us your questions, no matter how dumb, at the email address mhr@pensioncraft.com.
And do remember to check out PensionCraft.com for all the information about our membership and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.